everyone. Welcome to Leaders of Tomorrow, India's largest platform for entrepreneurs. Anything and everything to do with life of an entrepreneur covered right here on the show. I'm Sunanda Jayasilan. On the show today, we're bringing you personal finance tips with some of India's biggest clients when it comes to managing your money right. Today, I'm in conversation with the MD and CEO of Edelweiss Wealth Management, Nitin Jain. On the other side of a break, Shrumta of fee-only investment advisors. Let's talk about FI and DI flows. Strong FI flows continuing in 2021. What's your view on that, Nitin?
Absolutely. I think, as I said earlier, I think from a long-term point of view, India presents a very compelling investment thesis, right? So I see no reason. And please bear in mind, FII is a volatile stream of inflows. Equally important are FDI flows. If you see, even FDI flows have consistently gone up. Even last year, if I'm not mistaken, the numbers would be order of magnitude $45 billion. And they are long-term, they're more steady in nature. And I see the FDI flows continuously growing over the next few years. We are seeing very, very large pension funds, sovereign funds, private equity coming into the country and very actively looking to invest long-term into India. So this is a trend. This is going to stay here. I see no challenge unless we make big mistakes on the regulatory side or anything which will make doing business tougher in India. So unless we score a self-goal, I don't see why in such a low interest rate regime, a country which is doing so well, where the demographics is so much in favor, will not continue to attract capital. So that's on the global flows coming into India.
Okay.
What we are witnessing, though, in the domestic is fascinating. I don't think I would have expected this to happen in India, but we are seeing it now. The DI flow used to be negative in the last 1 year, right? And it's bizarre because we are seeing, on the other hand, retail flows coming very strongly into the market. So on the mutual funds, the flows are going out, but the market parts, the retail is coming directly into the market, which is interesting because the clients are saying that maybe the cost of managing funds are higher than what they're willing to pay, or they want more empowerment, or they want better funds. There's some level of disintermediation happening in such positive markets. Why should money be going out of the funds? And that's something that we have to introspect and think hard about. I don't know if this is really structural, but this is something very counterintuitive that's happening, that the markets are going up. Money is pouring into markets, but money is going out of the mutual funds. We'll have to wait and watch how this pans out. But this is something to introspect.
This is the part of the interview where we discuss advice. What advice would you have for entrepreneurs based on your personal experience, perhaps something that you've seen by way of mistakes that are most commonly made when it comes to managing money that you could tell our viewers?
Actually, quite a few, to be honest. But there is no substitute to planting a tree 30 years earlier. If you had planted that tree 30 years earlier, you would be reaping fruits today. But the best time to plant a tree is today. So I don't think you can start earlier than when you started. So there's no point of regretting that. But now it's about making the best of what you have done. So that's point number one. But the second, I think for entrepreneurs, because I also come from a family which has a lot of business people, some of the common mistakes that I have seen people end up making are actually on the financial side. And that's something that I would love to spend time educating people. And even in my personal capacity, I do mentor a lot of entrepreneurs. I think a common mistake, for example, is around mixing their personal balance sheet and their corporate balance sheet. What do I mean by that? Borrowing in their personal capacity from friends, family, and investing that money without thinking very hard about the cash flows of the company.
Okay.
So you will borrow on a personal capacity and invest that money in your uh, business venture, thinking that that is equity. But the cash flows have to eventually match, right? Because that is not equity. The best thing to do is actually to work harder, to work with banks and find ways and mechanisms. There are many banks, many institutions which are available today who can help you finance those ventures. But rather than actually going to the right institutions, going to the right people who help you get those financing, people find an easy way out, going to their family, friends, and borrow that money at much higher cost, much worse terms, and finance their businesses. And I think that is a bad outcome. I've also seen another tendency of people to try and get into too many things. Start a business, get into multiple lines because they want to show growth. They want to demonstrate to their competition or people they know that we are into a lot of new lines, etc., etc. At least I have seen that the biggest amount of variation or value creation happens when you are a leader in a particular line of business rather than doing many things at the same time. So my request and suggestion to anybody is to excel in whatever you're doing, even if it means that you have to compromise on the number of things that you're doing. So these are the two things that at least we have seen in the entrepreneur segment are the common mistakes that people end up making. And if you're lucky that your business is throwing a lot of cash,
okay,
and you are looking to invest that business, then that's a great situation to be in. To be honest, I think especially in the beginning, when you're starting off, there are very few people who will create that kind of wealth. Then be very careful about diversifying that money and being prudent about managing that money and not just using that to leverage yourself and expanding to unrelated set of businesses. So that would be my some experiences that I've had with a few entrepreneurs.
Nitin, you were speaking about consumer tech, and you primarily, consumer tech is what we've been discussing. But I want to talk about education and education tech, and I want to talk about health and, the health tech, healthcare companies really. Do you have a view on any of these sectors, any of these companies?
Absolutely. I think a lot of these sectors, Nanda, are going to do extremely well, right? Whether it is consumers, whether it's technology, we see massive growth opportunities across a lot of these places. I think you're seeing various new models emerging, which is a combination of technology and consumption. There's a lot of disintermediation happening in distribution models. There is a lot of new kind of demand emerging from different client segments, whether it is insurance, whether it is education, whether it is healthcare, whether it is companies like Policy Bazaar, companies like Byju, companies like delivery companies. So a host of new models are emerging. And we think a lot of these companies will not only do very well, but they might find a very different set of investors as well, different set of global investors. So I think these are very interesting times, and I think you are absolutely right. Some of these companies will do extremely well in India.
Nitin, any anecdotes that you have that could be shared with our viewers as we are ending today's conversation?
No, I think I am a very big believer in asset allocation, diversification, and very simple principles of managing. When we started this journey in Edelweiss, I think I remember the initial few questions to us were always around, give us 3 or 4 great ideas in stocks. Tell us 2 or 3 good mutual funds to buy. And I think we will keep on talking to people about asset allocation, financial goals, long-term planning. But I think there was always a resistance about these kind of conversations. What we are starting to see though now, and very gratified about it, is that those conversations are becoming more common. Our clients are becoming more receptive towards it. And I think disciplined long-term planning is the key towards financial success. And I would request all your customers, all the viewers of this conversation to please focus on those 2 parameters, discipline and long-term planning. If you can stick to that, I think outcomes will be awesome.
One last question then, in terms of the RBI's restructuring scheme and any perhaps have on that?
I must say, there are many ways of getting the loans restructured because there is no such regulation which stops the from getting restructured. In fact, if I'm not mistaken, there is a pre-pack scheme that has got launched under Section 29A, where most of the SMEs can actually go to NCLT and along with the bank, they can get their company loan restructured under the NCLT scheme. This is like a pre-pack, and this is actually a very interesting scheme, and I think more color will come on this proposal over a period of time. But I do think most of the SMEs should figure out a way to balance out their debt and equity capital structure. If they're not able to find the right solution to their problems, I think there are many advisors on the street who help manage their capital structure, investment banks, ARCs, etc. They should seek their advice. But this is absolutely the right time to go and seek help and get their balance sheet in the right in the right health, because the next 5 years will be very good from the Indian economy point of view. And if you are ready, if you're healthy from a balance sheet point of view, I think your businesses will do very well.
Thanks so much for taking the time to speak with us here on the Leaders of Tomorrow. I want to start today's conversation by talking about risk and reward and the correlation really between the two. It's always seen that equities are more risky and therefore give you a higher rate of return. Anything that you want to tell us, what do you advise your clients when it comes to looking at equities as an asset class? What's the correct way to approach them? Any insights you can give us?
So I think the key thing for people to understand is that risk and reward are, two sides of the same coin. Very clearly, when you want high returns, and let's say by risk, you mean the risk of losing the nominal value, the so-called value of your capital, if you call that as the risk, and if you want to have zero risk on that, then you have to be satisfied with low returns. I don't think that there is a possibility that you can have zero risk to the value of your money without taking some risk. So if you take State Bank of India fixed deposit rate as zero risk, and that, let us say, is 5% or 5.5%, then if you want a higher return than that, some amount of risk you will have to take. You cannot get that higher return without taking an incremental risk. I think that understanding people need to have. Two things with risk. I think people, when they talk of risk, they talk of the risk of losing principal. I think the other risk that people rarely look at is the risk of losing the purchasing power of their money. So when you put money in a bank fixed deposit with State Bank of India, let's say for 10 years, and you're getting 5% return on that. Now, from that 5%, first of all, tax will be paid. Let's say it's paid at 30%, which means your return drops to 3.5%. And at the end of 10 years, although nominally your money will grow from whatever it is that you have started with, but the things that you can purchase with that money will be much less than what you could have purchased when you started with. So this so-called low risk invariably will mean that the purchasing power of your money will be lost over a period of time. That is for sure.
Then let's also discuss equity and SIP. What's the correct way, that you should be looking at? Do you think there's enough awareness amongst people, amongst young people, especially young entrepreneurs, when it comes to equity and why they should perhaps be looking at it? Do you feel it's more skewed perhaps towards equity, and how can that be corrected?
I think given the amount of financial education that has been uh, going on, which is very, very good, I think people think that a systematic investment plan in an equity mutual fund is a riskless way of creating wealth. So two things I want to talk about. One, I think people say, I want to do SIP. SIP is only a method of investing. When you regularly invest a fixed amount of money in a bank fixed deposit, it is called a recurring deposit. When you do the same in an equity mutual fund, any mutual fund for that matter, it is colloquially called as a systematic investment plan. You are systematically, month after month, putting money into a mutual fund. I think a lot of people think SIP is a magic bullet that somehow takes the risk out of an equity mutual fund, and that if you do a systematic investment plan for a long enough period of time, let's say 10 years, okay, and that is really what is called long period, then somehow there will be no risk. The issue with that statement is that although it is true, it hides a lot of variations. So it is true that if you were to say pick up the Nifty index, and if you did a 10-year investment in the Nifty index, 10-year systematic investment in the Nifty index, there is no 10-year SIP that would ever result in a loss. That I think is correct. What that hides, though, is the fact that during that 10-year period, at least 98 to 99% of the time, that's literally 100%. A small sliver does not fit, but otherwise, 98 to 99% of the time, your money will be in negative. You would have made a loss before at the end of 10 years finishing in a profit, but during that 10 years, invariably, you will face a period during which your capital is at a loss. And in as much as almost 1/3 of that cases, that capital loss occurs after 5 years of systematically investing in a 10-year SIP. So imagine you have agreed to invest 120 installments, and after 60 installments have been invested, you forget return. You still have a capital loss. Now that is true in about 1/3 of the cases if you look at past track record. You have to be prepared to grit your teeth, continue with that investment if eventually at the end of 10 years you want to have a good return. I think this very few people understand, and therefore, they feel like they have been conned somehow. Somehow people have told them systematic investment plan is a great way to reduce risk, and yet late into a 10-year SIP also, 5 years is long term for a lot of people. We call it medium term, but a lot of people think 5 years is long term. And even after 5 years systematic investment, 1/3 of the time they may find that they are in a loss, and therefore, they may feel that they have really been. I think that is because their expectations have not been managed properly. I think if they were aware that this is a trough through which you have to go before you will achieve your objective, that if it was told to them and it was explained to them with data, I think that is something That is the role of advisors like us, media houses, to make sure that people have the right expectation from their investments.
Then, in your opinion, Harsh, why are a lot of people perhaps not doing SIPs? What do you want to tell us?
We won't say that it is not popular. I mean, I think March to 2021, we have had 9,000 crores added primarily to equity inflows through the systematic investment plan and primarily retail investors. So I don't think we can say it is not popular. I think what really is happening is that, one, I think it is taking time before we see consistency. We do see the SIP figures going up and down. Logically, people should not be dropping off when markets reduce or even when markets increase. I think SIP is the ability to keep investing. It works when you keep investing irrespective of that. That is how that strategy works. I think for that to happen, it will still take some time. The point is, the way to make wealth is boring. It takes a huge amount of time. Making wealth through SIPs is about as exciting as watching a plant grow. But when the plant grows and gives fruits, okay, after that, that process becomes very, very useful. I think a lot of people are realizing it, so I won't say it's not popular, but definitely I think a lot more people should be in there and they are coming. I think one more thing that is important with the SIP is, I think the whole focus of the SIP seems to be to get into a volatile asset class that goes up and down, get into it systematically, do it slowly over a period of time. I think what it misses is that you must also get out systematically. And I think this was dramatically, this was shown most dramatically during the breakdown that occurred in March 2020, when the Nifty index lost about 30% plus in the space of just between Feb and March. It lost about 31, 32%. Anybody who was waiting and who had a goal in March and was waiting for that goal date to approach would have suddenly lost 1/3 of his investment. That is why, as important as it is to get in systematically, it is as important to get out systematically. And our advice, we call it tapering out. Systematic investment is tapering in. Systematic investment out is called tapering out. It is as important to taper out. And at least say if you have a 10-year goal, maybe 2 years before the goal, start tapering it out from equity into debt. And I think doing that is as important to have a good eventual investment outcome, investment return outcome, as it is to slowly invest. So slowly invest, keep investing, do not get disturbed by any ups and downs in the market, and slowly disinvest. I think that really is the mantra for creating wealth.
All right, Harsh, thank you so much for your time on the show. Completely out of time on today's episode. If you have any feedback for us, do get in touch. Our contact details on your screens as we speak. Thanks for watching. Have a good night.